Casper, today we're going to talk about psychology. No? Psychology. Because why is psychology so important when you invest on the stock market? Because it makes you or breaks you as an investor, I think. Talking about the most important points, the fear and greed barometer, as you say that gives a really important indication of where we are in the market. But what is it exactly, and why are those two elements so important? Greed and fear.
I think they are important because almost every person has them and should have them, because if you don't have greediness in you, then you are not willing to develop and to improve. And if you don't have any fear in you, you are not afraid for everything, and you cross the street or you jump in really cold water. So you need those two elements, but you need to control them also.
Absolutely.
And what you see in the stock market is although there are large banks active, institutions, it's an emotional, psychology-driven market.
Especially for people just as us.
For everyone, I think.
Yeah.
And what you see also, the journalists, if you look at if you read a small newspaper, you watch CNN, they're all following each other, and the market is great, everything's going up because the economy is doing well, and the day later or the 2 days later it's all bad because there is some threat in the market.
Yeah.
Investors
Totally
are extremely sensitive for the fear and the greed index.
Absolutely.
And what we see now, every week we talk about a stock or an index or a sector. And this time, why we talk about this? Because we are in a period with low volatility. A lot of investors,
volatility.
Markets went up a little bit the last time. People think, okay, everything is fine. I don't have to look at my stocks. Nothing's happening too much in the market, in the economy, in the news. But especially in those periods, you should be aware of those elements. And we're going to talk about 5, and they are also from a theory. And we give some practical examples with it. And probably you will say all of them, yes, of course, yeah, I know, but maybe it helps you in this time before the summer, low volatility again, to look at your portfolio investment. Oh yeah, okay, yeah. It's just to help you in this time of the year with your investing.
Oh, totally true. And we do one-on-one, but I think from a perspective, the first one I want to talk about is the overconfidence. So it's an important one because I think a lot of times people underestimate the risk they are taking. They go in with too much, I'll make it, I can do this and I can handle this. But many times you see big guys, that maybe sounds a bit strange what I'm saying here, but they come back also, this hurts actually. Then it's also coming back in another point we're going to touch on. But overconfidence, and they think they have the skills to manage a risky situation. We are very small players on a very big market. Even though you're in it with a lot of money, it is still a fraction of what is on a daily basis moving around. If you talk about just large cap stocks, we are actually nobody. So we have to be only thinking about the risk and never underestimate the risk. Don't be overconfident.
And when you have an investor and he wants to buy Apple, and he or she did his homework, look at the fundamentals, look at the company, look at the outlook, at the markets, at the technical analysis, and you think, okay, I did my homework, I made my decision. Now it's going to be good because I checked everything, and that can be really disappointing for somebody. Say, okay, sure, but hey, it's going down, and it's going 10 or 20% down, but I did everything, and that's so the overconfidence. You should be aware of that. If you when you do your homework, it's not automatically success.
And overconfidence can also lead to the next point, which is in this case,
put all your eggs in one basket. Unfortunately, we see it almost on a daily basis that people have a portfolio and they have, for example, 90% of their portfolio invested in one stock and the other 10% divided in 10 different ones. Or in ETF, S&P 500 ETF, then you have a really broad index because you invest in the largest 500 shares of the US. That's for example on 10% holding in the portfolio, and then they have a share that is a 20% holding and a 30%. So the 500 together is 10%, and one share is 20 or 30%, and that can go well, of course. If that share goes up, then you make a lot of money. But if it goes down, then relative you have a big risk. And that combined is, of course, speculative.
It's very speculative.
Should not do that. So, and that, think about yourself, think about your investments, And of course, people will say Warren Buffett has his biggest position in Apple. So there also are examples that it will work, but he has a lot of other positions behind
definitely.
it. But think about yourself, especially, and I think you have two ways. So some people buy it from the beginning, a big chunk, but also it can happen that a certain stock or certain investment goes up, and then it's gonna be, it's automatically, it will be
A larger position.
yeah. So
Yeah, you have
and
to-
then it's always nice to sell,
Yeah,
because then you made a
readjust.
profit.
But it's also difficult, because they think that they look at the positive and they want to keep a hold on to that.
Suboptimal diversification
Exactly.
is that called.
Third point, confirmation bias, and I think that's also a funny one because everybody has that. You're gonna look for a new car, you only read the good things. If you already maybe, especially when you already did the down payment, you don't want to. Oh my God, I read that the car now has the issues with that. I had it a couple of times that I bought my car and then and this car has bought second hand and I said this car after so many kilometers has problems with this or that and so. And you think you look for the confirmation that the problem is solved quickly. Then you're gonna look for solutions. And then what I'm trying to say here is that when you buy a stock, many times you see people think they're gonna start looking for good news, and they want to confirm that they did the right thing, that they bought at the right moment. But you don't know that, and the price that you paid is not by definition a good price. It's the price you paid, but it's not the price that is maybe the price that it should be bought at. Yeah? There's no bell going off at the bottom. Okay, this is the price that you should all step in, because it's not possible. It's also not the price here you should sell. So looking for that confirmation,
And especially like products like gold, you have that, because you have with golds like two groups. One, they don't like it at all, but it doesn't give dividends, and the other one said no, okay, because then you have something
Safe
in your
assets,
hand, safe, and the two groups. So what we see for people that don't have gold, they don't like gold, they're only looking at the news. Hey, gold is down. Hey, no dividend. And the people that are really like gold, they always looking for the news that support their confirmation bias. So that's an.
Yeah, we see that also with stocks. The stocks that lately been negative, like DSM in the Netherlands, for instance. Yeah, it's going down, but they're always been performing so well. It's no guarantee. It's no guarantee. Next point.
Loss aversion, and that's. I think you will. If you are an investor, you have been experiencing this, and that means that if you make a 10% profit on a certain investment, you are happy.
Yes.
And they did a study. They did a couple of studies, but one was in 2015. I think we'll put it in the screen because it's quite interesting. And if you see it, hopefully you will recognize it. Then you say, 10%. You make 10% plus, you are happy. Your happiness goes up to a certain level. If you make on the same investment 20% profit, your happiness goes up only a little bit more, and with 30 also a little bit. So this is the chart, it's going up. The other way, if you make a 10% loss, your pain is already, that level is already more than that you have the pleasure on the 10% profit.
True.
So that's already not nice. And then if you make a 10% loss, the pain increases more than that the happiness, the pleasure increases. So if you recognize that, if you don't recognize it, you don't have to do anything about it. But if you recognize that, then of course what will work is to take your stop losses on a certain level.
Absolutely.
You buy a certain stock. In our platform, I came from a meeting with a client, and I showed him because he wanted to ask me, how do I do it? In the order ticket, so you place an order, you have already a button that you can push, and then you can already put your stop losses and your stop profits in.
Correct. Yeah.
And if you oblige yourself to do it in the same ticket,
Yeah.
then you always, otherwise afterwards you're going to do, and the prices drops, and then I'm not going to do
You're
it,
too
I
late.
wait.
You're
If
too
you do
late.
it in one ticket, you buy it for a certain price, and you say on 9%, 12, or whatever you want to put in, I take my stop loss. And then the pain, you don't have those immense pains. And of course you have times that it goes up again, and then you miss the pressure. But that, I think if you recognize it, that's the best way to, especially now, prices went up a little bit. Some went up a lot. Nvidia, we spoke about it last week. Put some stop losses in, so that you don't have pain as an investor.
Exactly, really important. The last point is follow the crowd. People read things, people hear things on CNBC. Now with the AI boom, everybody wants to buy Nvidia. Well, then I have to jump on that train as well. Same thing what happened about 6 years ago with Bitcoin. I took my kid to school, and the moms were talking about. That's not really nice what I'm saying here actually. But if it's a school bus topic to buy Bitcoin, then you should be careful, because then the news is everywhere, right? Even my grandma of 90 was asking about, do I have to do something with this? So, following the crowd, and it's also with investing the same thing. Be aware that you don't follow something that you want to be part of. Also, it's the same way that is FOMO, the fear of missing out on this one. You invest for yourself. You invest with a vision. You invest with an idea. You buy certain stocks because you think it goes up. You buy it because it has a certain amount of dividend. You're not buying it because your neighbor bought it, because your neighbor might have bought it already 6 months ago, and you have to buy it today then. So you might be buying it at a much higher price. So you might miss already out on the boom. Your neighbor might be thinking about selling. He talked about it because he had a positive result. That's also many times. You see people start talking very positively about something. Yeah, because it went well. And then you say, okay, well, I might have to do that as well. So be very, very careful with that. In the Netherlands, on Sunday morning, you have a business program. And always on Monday, we had the effect. Clients wanted to buy specific stocks that were mentioned in that program. And I think you should be really, really cautious with that, because you're not buying it based on your own vision. You're buying it because somebody is telling you, because you might think he might know what it's about. And look a little bit further down the line. Why is he talking about it? Why is this mentioned? Why are those people talking about it? Mostly because they are actually looking for the confirmation bias. They have loss aversion, so they are positive vibes. So they want to talk about something that went well, and then you want to step in on that because they say so, or you want to step in on that, or you want to avoid it. Make your homework.
And probably everybody recognizes those feelings.
Absolutely.
So that's normal. But control them.
Yes.
And don't follow the crowd.
No.
You can follow it, but do your homework. You can, but first do your homework, and then you decide, okay, I want to follow the crowd. And you are now probably watching. You're watching us on YouTube, and there are some funny videos on YouTube. Don't fill it in yet. First, look at the end of hours. And it's about following the crowd. And I did some tests in elevators. So that there are 3 people, I think, in the elevator. They are facing the wall, not facing the door. And then a person comes in, and he or she doesn't know about anything. And he thinks, what a strange situation. They don't talk. They go to the next level. Another person comes in. He turns around, starts also looking at the back of the elevator. And then that person is going to be a little less nervous. And that happens a couple of times, and then you see that person change. He or she knows that there is no reason for it, but he or she wants to be. He wants to be part of the crowd. And that's a normal feeling that you want to be part of the crowd.
Yeah, and that's a strange example, but it's a really typical example.
On the other hand, if you always go the other direction, never follow the crowd, you also should do your homework, because if everybody.
It's also a difficult one, because you also see never fight the Fed. If you think now the market is going up, it can't be true because the interest is going up and companies going to suffer and this and that and that. Yeah, but in the meantime, the market has gone up 12% since the middle of March. So don't fight sometimes also a big stream, because then you might end up paying also for that. It's difficult. It's really, really difficult, and it's really important elements, and there's no real answer. I think it's only it's also confirmation what we are doing on a daily basis is, of course, we don't give any advice, but we are constantly helping clients to put a mirror in front of them and say, what are you doing here? This is what you asked. I had the best example the other day, right? With the process share. Somebody wanted to, he was in a loss, it came almost back. So I'm going to sell it now. I said, well, but did you buy it then just to sell it at the same price you bought it? It's like, it doesn't make sense, Because if that's what you're only going to do, then you're always going to have small or no profits. And they had one stock which lost actually quite a lot. They said, why didn't you sell that one then? Yeah, you might be actually right here. It's typical loss fear aversion, and greed, loss aversion, all those elements. So, thank you very much for watching. I think this was it now. You want to wrap up with something?
No, I think this is what we said. This is in time that you maybe can use for yourself to look at your portfolio and
do some self-reflection.
Yeah.
Okay. Well, thank you for watching, and we'll see you next week.
Give us your time.
Give us your time.